Hi everyone, welcome to Anu's classroom. In this video, we'll be talking about zero-based budgeting. So far in MMPC 5, that is Accounting for Manager series, we have been discussing about budgets. And here also in this video, we are taking a discussion on budgets and budgetary controls forward by talking about zero-based budgeting. By the end of this video, I hope that you understand the concepts behind zero-based budgets. So let's get started. So far, we learned that traditional budgets are prepared on the basis of last year's performance with some addition and alterations, that is, after some adjustments. So, year after year, if a company is following traditional budgets, it will take last year's budget and it will make some adjustments to it, like adjust for inflation or any depreciation or anything like that, or things like that, and it will prepare this year's budget. That is it. So, this approach adopted in the formulation and preparation of budgets was based on the current level of operations or activities, including current level of expenditure and revenue. Therefore, it is not called as the traditional budgets. Okay, so this type of budgeting process, it generally assumes that the allocation of financial resources in the past was correct and it will continue to hold good for the future as well. But there were a few issues with traditional budgeting. One of the things that we learned while we were talking about why performance based budgeting came up was that traditional budgets found in traditional budgets we had no way of finding out whether the performance was up to the mark or not. That was not the only drawback with traditional budgeting. When we look closely, we find that programs and activities which involved wasteful expenditure we could not identify in traditional budgeting, which will result in unavoidable financial and other costs. Inefficiencies of a prior year will be carried forward in determining the subsequent year's level of performance as well. Managers are not encouraged to identify and evaluate any alternative means of accomplishing the same objective. Decision making becomes irrational in the absence of such rigorous analysis of all proposed costs and benefits. And managers will tend to inflate their budget requests, which will result in more demand of funds than what is available. And this will also result in recycling the entire budgeting process. So, keeping in mind of all those shortcomings, the technique of zero-based budgeting came up, which provided a solution for overcoming these limitations of traditional budgeting by enabling top management to focus on priorities and key areas and alternatives of action throughout the organization. As the term suggests, zero-based budgeting examines or reviews a program or function or responsibility from scratch, that is from zero. This technique of zero-based budgeting will, suggests that an organization should not only make decisions about the proposed new programs, but also it has to review time and again the appropriateness of the existing programs from time to time. That is, every time this budgeting is done at the start of budgeting period, when we are talking about zero-based budgeting, we reevaluate everything that we are doing and we will do in the budgeting period. That is what happens. Anything and everything that will be done in that particular accounting period, whether we have been doing it in the past or we are starting it new, either way we will reconsider everything once again, and we will go once again in search of a better contractor or a cheaper supplier, things like that. So the process is, first we determine the objectives of budgeting, then we decide on the scope of application, we develop decision units for which cost benefit analysis is proposed so as to decide if it should be dropped or continued, and we develop the decision packages. After completing this decision package for each unit, the units are ranked according to the findings of cost benefit analysis, and essential projects will be identified and given the highest ranks. The last stage is that of implementing the decision taken in the light of the study made. So, the advantages of zero-based budgeting are that it provides a systematic way to evaluate different operations, ensure that every program undertaken is essential and being performed in the best possible way, enables the management to approve departmental budgets based on cost-benefit analysis. It links the budgets with corporate objectives and helps identify areas of wasteful expenditure. And if desired, it can also be used to suggest an alternative course of action as well, because we are, evaluating everything there is. And it facilitates the introduction and implementation of the system of management by objectives. But as you might have guessed, by now it is a time consuming process. That is one of the major limitations or drawbacks of zero based accounting. So that is it for this video. I hope you understood about zero-based accounting. This is also one of the important concepts which is in relation to your term and examinations. We have had questions about what zero-based accounting is, what performance budgeting is, what zero-based budgeting is, and all. So in case you have any doubts, please feel free to use the comment section. If you like the video, consider giving us a thumbs up and subscribe to our channel if you have not yet. It will help me reach more people like you and grow our community, make our community much stronger, and help everyone who is going through IGNOU's MBA program. So if you feel that it will be worth joining the community and spreading about us, please, I strongly, what you can say, I request you to please do that in favor of the knowledge that you're gaining from our community. That is all I ask in return. So thank you very much, and I hope to see you all in the next video. Bye bye.